45 years, 0 name changes, new offices, more staff, improved technology to better serve you. Education, services, investments. Think real estate, think Marshall Reddick. Brokerage, property management, private lending, creating financial independence through real estate since 1979.
Okay, we're going to go ahead and start our presentation for this evening on asset protection and insurance for rental property. We would love to welcome you to this event. We'd love to welcome you to this event this evening. And Steve Page and I will be glad to give this presentation to you and answer any questions you have. First off, about Marshall Reddick, we are a full service real estate company. We are a full service real estate brokerage. We're also a property manager. We're a private money lender and an investment fund. So basically you have a one-stop shop here at Marshall Reddick to be able to help you with all of your investment needs, which this is a huge thing because there's nothing like that in the United States as far as we know of right now. And it's a really amazing company that started in 1979 from Dr. Marshall Reddick. A little bit about myself. I moved to Los Angeles in 1995, and I joined Marshall Reddick in 1996 as a real estate investor, and then later an agent and an educator for Marshall Reddick. I graduated from Florida State University and grew up in Sarasota, Florida from 12 on, prior to that Chicago. And I got a BS in business economics and a BA in English marketing and management. Over the years, I have bought 24 investment properties through Marshall Reddick, and I still have 11 of them today. I've been in real estate with Marshall Reddick for 24 years and have sold over 500 properties. I'm also a Marshall Reddick Mortgage Fund investor. I have a lot of experience working with builders, developers, investors, working project managing jobs. My dad was an engineer and a builder, so I pretty much grew up on job sites, and I just love all aspects of real estate investing. I am a single mom of 2 kids. Well, they're not so much kids anymore. Harrison is 24 and just getting ready to start law school, and my daughter is in her sophomore year planning to be a doctor. I am a huge animal advocate and have 3 dogs, 2 of them which are rescue animals. So a little bit about our national footprint. Marshall Reddick is located, our main office is here in Orange County in Newport Beach, California. We also have boots on the ground offices in Riverside, Los Angeles, and the Bay Area. We are also heavily in Texas, New Brunswick, San Antonio, Austin, and Houston. We also have 2 offices in Tennessee, in Clarksville and Nashville, and we also work from those offices in the Kentucky market. And we also have an office in South Florida in Cape Coral. So how does Marshall Reddick choose where to invest? Well, the job market is very important. We want to see steady employment and businesses moving into the area. We also look at the vacancy rates. Why this is important? Because if you have a high vacancy rate, that means that you have too many rentals to support the market, or there's employment moving out, or there's not enough jobs in the area. So the vacancy rate is very important. We want a lower vacancy rate. Economic diversity. We want an area that is completely economically diverse in all different facets. So for example, we wouldn't want a town that is just solely manufacturing cars. We want something very diverse where it has biotech and hospitals and manufacturing and maybe an Amazon plant, all different things that are diverse. Housing affordability is very important. We pick areas that has ability for people to buy. So many of our tenants often become owners, and many of the owners end up buying more investment property. We also want states that are landlord-friendly states. Aside from California, all the states we're in, it's very easy to get tenants out should there be any problem. We also like areas that have strong educations, universities, a great school district, a lot of different training available in the area. One of the most important things you'll find when you invest in investment properties is having reliable property management that is communicative and that offers good accounting services and great contact with a team of people, which Marshall Reddick has. So these are some of our offices in our different location. We have our Newport office smack in the middle of the page. We have our Cape Coral office on the bottom left. We have our different Texas properties, but you'll see we have a huge team of about 150 employees, and which you can see on all the pages here. I next would love to introduce you to Steve Page. He is one of our preferred Marshall Reddick insurance advisors, and he has done an amazing job with all of our clients providing all of their insurance needs, whether it be their personal residence, investment property, or an umbrella policy. So Steve, I'm going to let you take over.
Thank you, Christy, and good evening, everyone. Thank you for being here. Happy to have you, happy to join you and share a little bit about asset protection and insurance and what we can do to help protect your investment properties. So I am actually a fellow real estate investor. I've been a Marshall Reddick client for maybe over 12 years now. Bought and sold properties in 5 different Marshall Reddick markets. Also an investor in the fund and done private investing as well. And I'm also a licensed insurance agent. And so our agency is called Fidelity Insurance Services. We're an independent brokerage. We started in 2006, so almost 20 years now. We have access to over 100 different carriers, and we operate in every market that Marshall Reddick does. So California, Texas, Tennessee, Florida, we're expanding all the time, and many more. And we're very proactive in our approach because we're always looking for better deals, always reshopping it, trying to find the best deal for you, and make sure you have the right policy. We also have a great claims department. We have a whole separate team for that. We also have a separate billing team dedicated to renewals, policy changes, everything you need. So we're a one-stop shop there. And my branch specifically caters to real estate investors. I think there's a little lag in the slides here. Let's see. There we go. So my branch specifically runs the Investor's Choice program. I'm going to try and go back to that. And our whole thing is simple. It's just we want to make hassle-free insurance for real estate investors. So our goal is to make it fast and easy as possible. We want to give you proper asset protection, maximize your cash flow, get you set up with A-rated carriers that you know are going to be there if and when you need them. Hopefully you don't, but if you do, we want to make sure it's a good, strong carrier. We offer a low price guarantee. We have an all-star service team and also do advisory services. And you know, I'm a fellow real estate investor, so I speak the language. I understand what you guys need, what you want, what you're looking for. I want the same thing. I want the lowest cost policy possible, but I also want to make sure my properties are protected. I want to make sure it's a good carrier, a strong carrier, and that everything's taken care of. So that's our Investor's Choice program that we run. We're strictly by referral only at this point. About 6 months ago, we stopped advertising to the public and went referral only. Anyone in the Marshall Reddick family coming from there, we're happy to help you out. And there we go. So in that sense, we're kind of like a private club these days, but our whole goal is to figure out what's important to you, see what you need, what your goals are, what your concerns are, and then custom tailor the policy exactly for you and what you need. And just there's always a sweet spot for that perfect balance between asset protection and cash flow. We want to work with you to figure out what that is. We also work really hard to provide quotes the same day. Sometimes these days, especially with underwriting taking a little bit longer, sometimes it's not always the same day, but that's always our goal. Typically within an hour or two is what we aim for. And we want to make the process as fast and fun and easy as possible, even though it's insurance. So here's a couple of people. You might even see your name in here if you've worked with us, but a lot of people happy with us lately. Took these from the last couple of weeks on Google. And then here, this is hopefully the only slide that's a little slower, and then we'll get moving again. So for anyone just coming in, they're wondering what is this or new to this, what is insurance? Essentially, an insurance policy is a private contract between you and the insurance company, and where they're making a promise. They're promising to restore you to the financial condition you were in prior to the loss. What's a loss? What kind of loss? There's actually 16 different ones. They call them the 16 perils. If you want that, send me an email. Happy to send you that list so you know exactly what your policy is going to cover, what it'll do for you. That's important. But it's things like fire damage, water damage, wind, hail, smoke, explosion, vandalism, tree falls over, liability if someone gets hurt on the property, all those kinds of things. That's where the insurance policy can step in, save the day, and restore you back to the financial condition you were in before the damage happened. And each individual policy will spell out the various sources of damage covered. Sometimes they're a little bit different. Things like earthquake and flood, they're always separate policies. So you always want to look at the policy to see exactly what you've got. And then the insurance climate right now. Right now, a lot of times insurance it's tough these days in many areas. And the reason for that is there's severe weather events. We've had more hurricanes, more fires, all those kind of things, the political landscape, a lot of inflation with the current economy, a lot of big factors that are making insurance harder to find or making the costs go up. And that's what we're here for. We want to help you navigate it. So one of the great values of a good broker is we know the landscape. We know the best places to shop, how to find what you need, how to find the right kind of policy for your exact situation, and set up the coverages right. And then, of course, structuring it so you can have the lowest possible premium. Because at the end of the day, the less you're paying, that just translates into more cash flow on the back end for you. So that's important. We always want to make sure we're getting that balance. And big things I'm hearing right now from our clients, the big concerns they're having is saying, well, hey, what if a tenant damages my property? What happens there? Tornadoes, Texas, Tennessee, a lot of these places are getting a lot of tornadoes. California's very well known for all the fires. Hurricanes in the south, we had a few come in just within about a week this year. And as a result of these things, insurance costs are going up, becoming unaffordable in some cases. So they're going, how can I lower my premiums? How can I get my costs down? So I want to talk about that because those are the big things that seem to be on everybody's mind today. So the first one is pretty simple. If a tenant damages your property, there's two layers of protection there. One is on your policy as a landlord. That can be protected if there can be coverage there from the vandalism coverage. So if your policy has vandalism coverage and they were intentionally trying to damage the property, that's where your own policy can kick in and help out. It can also come out of the renter's insurance policy. So your tenant should always have a renter's policy. And what happens there if it was accidental damage, then usually it would come out of the liability coverage on the tenant's renter's policy. The rest of these things, let's dive in because those are really, really big concerns right now. They're very important. They're important to me. I mean, like I said, I'm a fellow real estate investor. I want to pay as little as possible as well. I want to make sure my assets are protected, but I also want to pay as little as I can. And so for me, it comes down to changing the way I'm thinking. And my answer is think like a billionaire. So a lot of people know Warren Buffett, household name, one of the greatest investors on the planet, billionaire. This is a quote by his mentor, who's Benjamin Graham. And he always said, successful investing is all about managing risk, not avoiding it. And so that's the goal. We can't avoid risk. Everything we do, there's risk. You drive down the street, there's risk. You go to a restaurant, you're risking food poisoning. There's always risk in every single thing you do. So what we want to do is manage it as best we can and in the ways that are meaningful for us. Certain people have certain risks they're more concerned about and they're not concerned about others, and vice versa with other people. So insurance is nothing more than a financial tool that we can use to help manage the risk, the various risks in life, like potential fire risk or liability risk. So that's the first part. The next thing I always say with this is pull back and let's think big picture. If we take a bird's eye view of the situation, the first thing we always do, like in a situation right now where insurance can be harder to come by and it's costing more and all this is, we react a little bit and think, oh no, what's going on? My insurance prices are going up. It's crazy. It's always going to be this way. And we tend to freak out a little bit. But one of the best pieces of advice that was ever given to me is just simply for each individual property, every rental property I have, just treat it like its own business. Think of it like a business. And so for things like this, it's not personal, it's just business. In any business, there's costs involved, and insurance is just one of those costs of business. It's one of the prices we pay to play the game and manage the risk involved. And that really helped me when I first heard that, really think of it differently. And everything has cycles. Things go up, they go down. Right now, insurance costs are up. It's just part of the cycle we're in. It's not forever. I have a very optimistic, positive view based on everything I've been seeing that things are going to stabilize in the insurance market, rates are going to come back down, and it'll be business as usual. So that's for now. And then long term, again, I really believe that looking back, these higher costs that we're seeing right now will just be a blip on the radar. As time goes on, rents increase, that offsets the cost of insurance, that offsets the cost of everything else. equity builds. Eventually down the road, depending on how long we hold it, we sell the property. Looking back, you might have spent, a little more on insurance along the way, but when you sell for hopefully several $100,000 more down the road, that's going to be a little nothing. It's going to be a little speed bump. Same's true if you hold it until the loan is paid off. Now your cash flow is better. These things, you have much bigger margins, so they're just not that big of a deal as you go down the road. Obviously, we still want to pay as little as possible, keep the expenses down as much as we can, but that's how I'm looking at it right now, and that really helps me, and I believe that's true. But far worse than temporary higher insurance costs that eat away at our cash flow a little bit right now, the biggest threat is losing principal. So our initial investment, that's the bigger threat. So back to Warren Buffett again, he's a big fan of leveraging your downside. And I love this quote from him. He says, rule number 1 is never lose money. And rule number 2, never forget rule number 1. And it's so true, because anytime we lose principal, it's so much harder to come back. We have to make so much more money to come back to, just to get back to where we were, to then start moving forward again. So here's like a quick example of how insurance can help with this is, here's what not to do, right? Let's say you buy an investment property, it's $300,000, and there's a fire, it burns to the ground, and you don't have insurance. How long does it take to earn another $300,000? How much time does that take? How much energy does that take? We've lost principal, and now we got to get all the way back to that point to get another property, just so we can get back to where we were to start moving ahead again. And if that happens a few times, it becomes nearly impossible, if not impossible, to get ahead again. But on the contrary, if you have an investment property and you got a good policy, even if, hopefully it doesn't, but even if the house does burn to the ground, the insurance takes care of it. Your house is rebuilt, you still have your $300,000 property, you can keep moving forward. See, you haven't lost any principal, so you've been following rule number 1. So those are the things I think of to help me with the insurance climate right now. But the basic idea is if we never lose money, never lose principal, we'll get ahead faster, we'll stay ahead. And that's how insurance can fit into this equation and help make it happen. And last but not least, I really believe there is a hidden asset, and that is the mindset. Because anytime there's increased costs, and I think this is true anywhere in life, anytime there's increased costs, there's unexpected expenses or difficulties, anytime something that we think is negative is happening, that's an opportunity for learning, for growing, discovering new ways to think, all of which is going to benefit you, help you be more successful and a better investor going forward. I know, Christy, you could probably talk about this, but every property I've had, I've learned more that has made me a better investor and helped me make more money in the next one, and also learn things that I may do again, may not do it again, or do differently. Would you agree? Have you had that experience?
Yeah, I mean, absolutely. And, I've started buying investment properties in 1997. That kind of ages me. But, and like I said, I bought 24 through Marshall Reddick. I still have 11. And if like December 9th of 2023, my house in Clarksville, Tennessee was struck by a tornado. I had $27,000 worth of damage. I was completely, and it took me like 6 or 7 months to fix the house again, but actually the house ended up better afterwards, because a lot of what I like with these type of things is you get things like, my roof was 10 years old. They paid for a new roof for me. My siding was older and it was kind of getting beat up, and they paid for new siding for me. They paid for new windows for me. So actually ended a year prior to that, I had remodeled the house, and now the whole exterior of the house is remodeled as well, and it was all covered by insurance. And I think I only ended up being out of pocket about $2,000 out of that whole thing. So it was really, right? The deductible, right? Mm-hmm. And actually even the deductible, normally you find ways to save a little bit on that as well. So and I have 5 properties in Florida, and we just got hit with the hurricanes as well. So the insurance is really, like anything that happens to you, it may happen, but you'll get through it. And it actually makes your properties better, because you're ending up getting new replacements on items.
Right. That's right. Absolutely. And that's the whole thing, is insurance is a plan for risk. How can we mitigate all the various things that can happen in life, happen in real estate? How do we mitigate them so that we're not financially impacted, so that we can maintain that rule number 1 that Buffett says, and keep moving forward and keep growing in our wealth? And so that's the whole idea. So I always think that hidden asset of knowledge and experience is such a big one. And I don't think we can forget about that. That is an asset, you know. And those slides are sticking again. Here we go. So what do we do in response to all that? You know, because it's true. It is harder to find right now, especially in certain areas, and it can cost more. So there's a number of things we can do, though. The biggest thing is we adapt. We adapt to the current condition, and we stay flexible. So we shop different carriers. We play around with coverages. We play around with deductibles. We figure out where we can cut things, or you know what's available to cut, or things that maybe we don't need as much of. Anything we can do to fit the current market, fit the current situation that you may be in with your property, or whatever you need to do, so that we can maintain as much cash flow as possible, make it as profitable as possible. That's the idea. So that's my approach to that. And then a lot of the things we've been, yeah, go ahead.
Oh, I was just gonna say, like, one of the things that I've been doing as an investor lately is where I used to have like $500 deductibles or $1,000 deductibles. Now I increase my deductibles as 2%. So that helps me save a lot on my premiums. And I also play around with my insurance coverage. I still have coverage, but sometimes I have coverage that I don't necessarily need or that is too padded. And so I adjust those as well, and it brings my insurance premiums way down. I just like reduced one premium in half that I had because I had it on a $500 deductible, and I changed it to a 2% deductible, and I reduced my insurance from $1,500 a year to basically $700 a year just by doing that.
Amazing. And that's exactly right, and exactly the kind of thing we're talking about doing. Deductible, by the way, raising the deductible is the fastest, easiest way to lower the premium, lower the cost of the policy. So that's one of the easiest ways. I'm a big fan of that. I tend to keep my deductibles at around 2%, usually wind and hail, and $2,500 to $5,000 for the general one, depending on the area, what the situation is. But that is the easiest way to keep the cost down. So some of the common problems we're seeing right now, you know, a lot of people come in, they have insurance, they're shopping, they're looking for a better deal. And a lot of times they send me their policies, and we notice some glaring errors that I just wanted to mention because these are things everybody should know about. You really want to make sure you have this stuff right. So here's I put together a list of some things to look out for. One of the big ones is just the wrong type of policy. Lately, especially, I've been seeing so many homeowners, well, they have a rental property, but it's still insured as their primary home. So they might have lived there at one point, they moved out, turned it into a rental property, but they still have homeowners insurance on it. And what they really need is a landlord policy. So that's a big one I'm seeing a lot of lately. Another one is not enough liability coverage or personal injury coverage, or just not enough. You know, we live in, sadly, a very litigious society these days. So, and liability coverage tends to be very inexpensive. So we can add that on or max that out and just give you that peace of mind there. Personal injury coverage is one that a lot of people aren't familiar with. Not every policy offers it, but it's a good one to have, especially as a landlord. That's where you'd get coverage for something like if your tenant claims that they were wrongfully evicted, that's where something like the personal injury coverage would swoop in and save the day and help you out there. So those are two big ones. Another one, a lot of people are underinsured right now, meaning they don't have enough insurance. And that doesn't mean it has to drive up the cost like crazy. A lot of times I can find people the right amount of insurance and still even save them money. But underinsured just means you don't have enough coverage right now. The big reason that's happening these days is because of all the inflation. So like take California, for example, a couple years ago, the cost to rebuild on average, the figure that we go off of was about $175 a square foot. In the last couple years, it's gone up to at least $300 per square foot. A lot of people still have their policy where the amount of coverage is based on $175. So if, God forbid, anything were to happen, there wouldn't be enough there to rebuild the home. So that's a big one we're seeing. Another one is the wrong occupancy. It's really important for carriers. They tend to be sticklers about that sort of thing with underwriting. Is it your primary home? Is it a second home, a vacation home? Is it a rental property? Is it like a vacation rental? Is it just vacant, sitting there waiting to be sold? Another one is not having extended replacement coverage. That's a great way to get a lot more coverage with only paying pennies on the dollar for it. So one of the ways we can really help people out price-wise and still get them even more coverage is by lowering the amount of dwelling coverage as much as possible and then maxing the extended replacement coverage. A lot of times when you do that, you'll end up with even more coverage than you had before, but it costs you less, save you money, and we're back to getting you more cash flow as a result. Another one is exclusions that a lot of people are unaware of. Like a lot of carriers right now, they understand things are costing more. They're trying to provide solutions to help people out, make more affordable policies. But one of the ways they might be doing that is lowering coverage on certain things. So like water is a big one. There might be limited water coverage or even no water coverage. And water claims are 70% of them on average. So, and there can be a lot of other things that are excluded from the policy. So you really want to make sure you know exactly what you're getting and have the coverage you think you do, so that hopefully if you ever have to use it, you have the coverage you thought you did. Another one is property managers or lenders. They're not listed on the policies, or they're listed incorrectly. If it's a mortgage EPIL policy where it's paid from your impound account, we just had this happen not too long ago, where someone's loan was sold and they didn't update it, and because of that, the lender didn't know, it didn't get paid for and the policy canceled. So it's really important to make sure we have the lender listed properly, especially if they're the ones paying for it. A big one we're seeing is, some people are getting these great policies, but only the deductible's $20,000, $25,000. I saw one the other day was $70,000. It's just huge. For most people, that's, if you ever had to use it, that would be cost prohibitive. So that can be a big one. Another one is not enough income protection. So if you have landlord policies, should provide compensation for lost rental income if your tenants have to move out due to some kind of damage. A lot of policies don't have that these days, or they don't have enough. So that's one to look at. You also want to make sure it's really properly integrated with your trust, your LLC, and your umbrella. That's a big one. Christy and I are always talking about this. You want as many layers of protection as possible, right? So having that all integrated properly is really important to make sure it's all going to work the way you intend it to.
Yeah, and always check your insurance agent, because on some of my policies, they want the policies in my name, and on some of my other policies, they want it in the name of my trust in Florida.
Yes.
Like Citizens wants it in the trust name. And one little tip is never name the trust after yourself. Name it a different name, because part of the reason for the trust is to protect your identity, so that most of the time when you get sued, it's going to be because of a car accident, and the other side's attorney will look up what you own. And if they look up what Christy Dietz owns nothing. But because I have everything in Reichert Trust. So naming a trust not after yourself really helps protect your assets and your identity. And the loss of rental income, what you just mentioned, that actually just happened to me, because when you own a condominium, you have what's called an HO6 policy, which is the interior, walls in. And I have an HO6 policy on my property in Siesta Key in Sarasota. And I had like a month and a half of lost rent, which is, probably about $12,000, well, no, $5,000, $6,000, $7,000, but I only had $2,400 in lost rental coverage on my HO6 policy, and I didn't realize that. So that is really important to look at.
That's a perfect example, and completely agree. The whole point of it is you want to own as much as possible, own nothing on paper, because the first thing an attorney is going to do if they get involved is an asset search, and you don't want to be a good target. You want to make sure you own nothing on paper, and that's where the umbrellas and the LLCs and the trusts and all these things can really work together to provide that extra protection. And so we want to make sure they're integrated properly and set up correctly with the insurance as well. So that's that. Then there's the incorrect structuring of multiple structures on one property. I just saw this the other day. This is becoming a big trend. Chrissy, I think you told me about a friend you had that's doing this too. A lot of times right now we're seeing people have on one property, they have a house and then they're putting in a back house or like a little granny unit or an ADU, that kind of thing. If those are separate structures, meaning they don't share a wall, that little back house needs its own policy. And I had someone come in the other day and they said they had that set up, but they only have one policy and they thought they were covered, and they weren't covered at all on the rental unit. Only their primary home was covered. They had no coverage on the back house itself, no liability coverage. Anything could have happened and they would have been, I don't even want to think about it. They were in a bad spot. So we got them all set up so they're protected now. And it was very, very inexpensive to do because they're tiny little properties.
Yeah, and Steve, you just did that policy from one of our Marshall Reddick clients. He had bought Oscar. He had bought a house and an ADU, and you made sure that the house was covered as well as the ADU was covered.
Exactly.
Which is accessory dwelling unit.
Yep. Really important to make sure we have that set up. So that's if there's multiple structures that don't share a wall on the same property on the same piece of land. Each structure needs its own policy. And that's a big one that can get missed a lot. Another one is not taking advantage of certain coverages that we can leverage to lower the cost of the policy. One I mentioned just a minute ago was the extended replacement coverage. If we can max that out and lower the dwelling coverage a little bit, a lot of times you can end up with more coverage and save money at the same time. Another one is the incorrect integration of homeowners associations. And that's especially if you have a condo or if you have a townhome policy like Chrissy, the one you mentioned. And there's loss assessment coverage for that as well. So if they want to assess everybody for a new roof, or there's a raccoon infestation or something, whatever it may be, you really want to make sure we have that right. So you're covered for those kind of things too. You don't want any surprise assessments.
Can I ask you on the loss assessment, are you allowed, Steve, to, because like in the state of Florida, the law requires that the HO6 companies give at least a $2,000 loss assessment. What if I wanted to increase my loss assessment coverage? Could I do that? Or do I have to stay with the state requires?
Every carrier is a little bit different, but just, what was it, maybe 3 or 4 months ago, I had a guy come to me and said, I don't know why, I just have a feeling there's going to be an assessment. Can you raise up my loss assessment coverage on my rental condo? And I said, sure, no problem. And he had a carrier that would let us go about up to the dwelling amount. So we went up to $75,000 for him. Sure enough, 6 weeks later, there was a $50,000 assessment covered.
Wow, I wish I would have known that. A $55,000 assessment. And I only have $2,000.
Yeah, there's so many little ins and outs and tricks to it. And just, that's why it's so important to kind of sit down. And it doesn't take that long. Just sit down and go through the coverage and say, hey, what's important to you? Are you concerned about this kind of situation happening? Are you concerned about that kind of situation happening? If you are, let's have a mitigation plan in place. And if you're not, then we won't worry about it. And that way you can customize these things to do exactly what you want it to do, where you're getting the coverage you want, the asset protection you want, the risk management you want, but you're not overpaying for things you don't necessarily need or want at the same time. So those are a lot of the problems we've been seeing lately with people coming in when I'm reviewing their policies. And the reason those are such a big deal is if any of those things are off, like if occupancy is wrong, or if it's the back house that's uninsured, all these kind of things, these can lead to denial of claim. These can cause you to think you have coverage when you actually don't, like the individual with the back house I had the other day. And all those things just cost you a loss of time, energy, money, create hassles and headaches, and you end up paying more than you need to. If you thought you had water coverage and then you didn't, and all of a sudden some pipe broke and you have $60,000, $70,000, $80,000 worth of damage, and then all of a sudden you find out, oh my gosh, my policy doesn't cover that, you're gonna have a bad day. Whereas if maybe you paid an extra $100 a year, you wouldn't have an $80,000 bill to clean up. So that's the kind of stuff we want to look at. Just make sure it's all correct, so save a lot of headaches. Yeah.
What happens, Steve, in a lot of these homes in Los Angeles and even in Orange County here, but a lot of homes have detached garage. Do you have to have a separate policy, or are they able to do one policy for house and garage if the garage is detached from the home?
Is anyone living in the garage, or is it just a detached garage?
No, it's just a detached garage, but it's still its own individual structure.
Yes, good. That's a great question. So,
yeah,
it's a really good question. If nobody's living in it, like if it's not a separate rental unit, then it's still considered part of the house, but it would come under the other structures coverage, not the main dwelling coverage. And so anytime there's a separate structure, what's that?
It would still be covered. Let's say if the fire comes or something happens and the whole property goes down, the garage would be able to be rebuilt also. You don't need a separate policy for that if it's detached.
Correct. It would come under the other structures coverage. So there's coverage for the dwelling, which is the main house that you or the tenant would live in. And then there's usually the next line item is a coverage called other structures. And that's where you'd find things for essentially any other structure on the property that is not the main house that you live in. So what's that? That would be a detached garage, a swimming pool, decks, patios, fences, gazebos, a back house, things like that. Anytime it's that kind of thing, that would be under the other structures. But if it's a tenant living in it and a separate structure, then it would need its own policy.
If you have a swimming pool, Steve, do you need to increase your liability insurance for that swimming pool?
That's a great idea. Just there is liability coverage for swimming pools. I always think personally, tend to be more risk averse, especially on the liability side, and liability coverage is so inexpensive. Like for example, the average cost to go from $500,000 in liability coverage to $1 million is an extra $40 a year. So to me, that's
Oh,
well
wow.
worth it. That's money well spent, you know? And then, because you're never going to find
Yeah.
cheaper asset protection than that. And then if you have a pool on top of that, yeah, I think that's a really great idea.
Okay. And how is a pool handled? Let's say that there's a fire that damages your pool, or let's say there's an earthquake that damages your pool. Would that be covered under the liability policy, or would that be covered under some other sort of policy? How is your pool covered?
Typically the pool would be under
Land-
other structures. That same one is like a detached garage. It's a separate structure on the property. The biggest threat to the swimming pool when it comes to claims is an earthquake. That's the
Right.
biggest threat, because if it cracks, and that's where the damage comes from. So anyone with a pool, especially, is even more if you're in California, I think earthquake coverage can be really important. And there's some carriers that offer that, and there's some carriers that don't. And a lot of people, they have an earthquake policy, they assume it has coverage for their pool, and that carrier doesn't even offer that kind of coverage. So you really want to make sure you have the coverage you think you do. And there are carriers that will cover the home and the pool and everything else for earthquake, and it can still be the same or less expensive than that other policy. I see that all the time.
Interesting.
Yeah. And that actually leads right in here, which is, here's another Warren Buffett quote for everybody. I'm on a Warren Buffett kick tonight. Price is what you pay, value is what you get. And at the end of the day, it's all about value. Like I keep saying, we want to find that little sweet spot between asset protection and cash flow, and making sure you have the coverage you think you do so that you don't lose principal and break that rule number one. And this is just an example. These are two different quotes from the exact same insurance company for the exact same customer, the exact same property. And what I wanted to show is the value in setting it up correctly. Like if you look at that one over on the left, it's a higher premium, right? So we'd probably naturally think, oh, this one has better coverage or more coverage. And that's not true. This one only has half the water coverage and half the liability coverage as the one on the right. And yet the one on the right, you can save almost $100. So you can get twice the water coverage, twice the liability, save whatever that is, I don't know, almost $100. So there's so many little ins and outs of going through these things and finding all the discounts and finding the right blend of coverages to get the cost down. And in this example, this is one of those great ones that I always put a smile on my face, where we can get more coverage and still save money.
Huh.
And Christy, to your question about the detached garage, it's kind of hard to see on the slide, but it says private structures. It's like the next line after dwelling in the property section. That's where a detached garage would come in.
Okay, I see.
Mm-hmm. All right, so let's get into some tips. Now we talked about, the current insurance climate. We talked about a lot of the problems we're seeing. Here's some things to look for and make sure you do with your policies going forward. There's, as much as possible, I always think it's best to have a full coverage policy. That means it covers from all 16 sources of damage. Again, if you want that list, send it to me. I'm happy to get that to you. Send me an email. I'll send it right back. And by the way, guys, feel free, if you have questions, type it in the chat box there. They'll pop up. Happy to answer anything. Don't worry about breaking my flow. All good. But it's always best to have a full coverage policy, and where you do have coverage for all 16 of those sources of damage, preferably full coverage from each. And then also the personal liability and personal injury coverage. Again, especially as a landlord, that personal injury coverage is where you have protection from a wrongful eviction suit. Another thing is you want to make sure you have replacement cost coverage. The alternative to that is something called actual cash value, or ACV for short, and that's the depreciated value. So that's like an equity killer, because I think everyone understands depreciation, but just as an example, let's say everyone knows this one. If you go buy a nice new car, and as soon as you drive off the lot, it's worth less than you just paid for it, right? That's depreciation. And every year it's worth a little less, worth a little less, worth a little less. It's the same thing here. So if you have one of these policies that's actual cash value, It might save you money, but you're probably not getting what you think you are. They're only going to give you the depreciated amount, depreciated value of the home, which is not going to be enough to rebuild. So it's not going to restore you to that condition you were hoping it would. It's not going to perform the way you wanted it to. Again, as much as possible, avoid the exclusions and coverage limitations. The goal being you want to have enough insurance. You don't want to be underinsured or potentially worse, under the impression you have adequate insurance when it turns out you actually don't. The next thing is make sure the occupancy is correct. Again, carriers can be real sticklers about this. So is the property vacant? Is it under renovation? Is it your primary home? Is it a landlord policy? Is it a vacation rental? It's on Airbnb, a VRBO, one of those. Is it a second home? All those details can become really, really important because the carrier could potentially have grounds for denying a claim if it turns out it was the wrong type of policy. So we always want to make sure it's the right type of policy and the right occupancy. The next thing we want to look at is using deductibles correctly to get that peace of mind and also lower the cost as much so you can have more cash flow. And deductibles can be really subjective. So I think that's always a good point to talk through. You know, I had one guy the other day who said, yeah, make the deductible 50,000. I don't care. And if it comes, I can do it. Okay, that's awesome that he's in that position, but not everybody is. So we want to find what's a deductible, which is the amount of money you'd pay out of pocket before insurance kicks in and takes care of the rest, right? We want to find out what's the amount you're comfortable with, truly comfortable with, not just, you know, what sounds good right now, but how much would you actually be comfortable with if push came to shove and something happened and we had to take care of it. We want it low enough where it's going to give you peace of mind if you actually had to use it, but we want to make it high enough to reduce your cost of your insurance at the same time. So it's a good conversation to have. As a general recommendation, if you have a single family home or a duplex, I usually recommend $2,500 for the deductible. If it's a 3 or 4 unit property, then I typically do $5,000. This is what I do for myself as well. Wind and hail, if it's in an area where that's applicable, I usually recommend 2%. That's a big enough jump where it can save you quite a bit on your premium, as Chrissy said earlier with your, I think it was a Tennessee property, is that what you said? You went up to 2% and it saved you a lot?
Yeah,
2% is a good one.
I've changed all my policies now to 2%. Except for a couple of my policies I've had forever. I have a couple in Missouri and they're still at $500 deductible because I've literally had the policies with shelter for probably like over 20 years. And so the policies are so inexpensive that I just leave it.
Absolutely. If the price is right and you get a low deductible, do it. And by the way, I just wanted to go back to this one because I thought, just in case, a lot of people say 2% deductible, 2% of what? That's 2% of the dwelling amount, the dwelling coverage amount. So for example, just for easy math, if the dwelling amount was $100,000, it'd be 2% of that. So your deductible would be $2,000, right? So that's how you do
it's
that.
not a lot.
No. But if you have $1 million replacement cost, you know, then it can start adding up, right? So but again, that's why those are good conversations to have, because everybody's in a different financial position. Everyone has different cash flow situations and what they're comfortable with. So next thing is always have a professional property manager, not just a property manager, but a professional property manager. I can say happily, Marshall Reddick is the best property manager I've ever worked with. I had a number of them before they started doing it, actually, and I have been a happy customer since they started. I was one of the first ones. I will never leave. They are the best in the business. I cannot say enough good about them.
Yep, I agree. Same, because I still have a couple properties that are outside of Marshall Reddick areas that's managed by other property managers, and it's just night and day difference. Not only their accounting, just trying to like get a hold. I've been trying to get one property manager in Missouri to replace my to put in a two-way clean out drain for 3 years now. And so now I'm calling plumbers myself because I can't seem to get her to do it.
And yet they're still getting paid for something, right? It's crazy.
Yeah.
And so if you've ever worked with a property manager and had a bad experience, you know what a blessing it is to find Marshall Reddick and work with them. It's such a different experience in the best of ways. Check them out if you're not already working with them. Next thing is insurance score. As much as possible, maintain a good insurance score, because carriers, especially outside of California, in all the states, pretty much every state other than California, they use this to help determine rate. your premium, your actual cost of your insurance. So if you want to keep your rates down, one of the best things you can do is maintain a good insurance score. And that's a factor of a few details. They can look at it differently, various ways, various states, but they look at credit score. And by the way, that they don't do a hard check on your credit score, like if you're getting a loan, that kind of thing. It's called a soft pull. So it doesn't affect your credit. You don't have to worry about it in that regard. It's not going to affect your financing or anything else. But they look at credit score. They look at your claims history. If they see you're very claims happy, you're the kind of person that makes a claim to change a light bulb, they're going to go, wait a minute, I don't know about this. Whereas if you're the kind of person that doesn't have any claims or maybe has very few, that's going to reflect more positively. They also look at debt. They also look at your payment history. Do you miss payments? They look at your credit history. They look at pursuit of new credit. How many loans are you trying to get? How many credit cards are you trying to open? All these kinds of things. And those together can create factor into your insurance score, which has a large effect on rate.
How long does the claims history stay on your policy when you're trying to get?
Yeah, it depends on the carrier. As a general rule, 3 years that it can be on the report and kind of be, quote unquote, held against you. Some carriers will keep it on the record for up to 5 years, but it doesn't necessarily work against you. It's just kind of there for reference. But 3 years is a good point of reference for that.
So do you get penalized if you have multiple claims on rental properties versus like your own residence if you're trying to renew another rental policy insurance or try to find a new carrier?
Yeah, you can. And the way it depends on the carrier, they all can do it a little bit differently. Some look more at the property. Some look more at the owner, like it follows the owner. So if, for example, if you had 3 rental properties and you had a claim on each one and then 2 claims on your home, the next time you go looking for a rental property policy, all that could show up on some carriers. Whereas other carriers, none of that will show up because there's no claims history on the new property. So it really depends. Sometimes they follow the property, sometimes they follow you, sometimes it's a little bit of both. And that's another thing to discuss. That's something that I love to discuss with my clients, because in knowing that, if I find out, oh, there's a claims history here, or this property's had some issues, there's certain carriers that don't mind as much. So we can go there and we're not going to have a problem. The rate won't be too bad and we're all good. Whereas if we try certain carriers, they're going to, cross us off or charge too much. So it's a good thing to talk about. Another thing is always have your tenants have a renter's insurance policy. Another blessing of a professional property management company is they're going to require that of the tenants. And again, you want as many layers of protection as possible. We talked a little earlier, you want a landlord policy, you want a trust, maybe an LLC, maybe an umbrella policy, but having your tenant have a renter's policy is just one more layer of protection as well, because that provides liability coverage. So if they have a guest over and someone gets hurt, that could hopefully be on that policy. If they have a dog that bites someone, hopefully that's on that policy. It's just one more layer of protection. It's, I think, indispensable. And it only costs your tenant, usually like $120 to $200 a year. Very inexpensive. So it's not a huge burden to require them. Next thing is, and we talked about this a couple times, just making sure those trusts, those LLCs, those umbrellas, everything is integrated properly on the policy. We want to make sure everything's listed in the right area in the right way, with the property management, with the lender, with the umbrella, with the trust, with any other entities like LLCs, all that stuff. We just really want to make sure it's done right, so you're getting that protection that you are intending to get. The next thing, always recommend an umbrella policy. It's just the best low-cost form of asset protection. And the really cool thing about umbrellas is that one single policy will cover all your rental properties, as long as they're in your name, right? It'll cover all your rental properties, and it'll also cover your personal home and for your auto as well. So it's extra liability coverage above and beyond what your auto policy is providing, above and beyond what your home policy is providing, above and beyond what your rental property policies are providing. It just covers everything above and beyond that with that one single policy. And we do have a newer carrier we just picked up recently that will even allow us to add different entities. So if you have trusts, if you have LLCs that own these properties, as long as they're not engaged in other business activities like running a business of some sort, they just hold properties, you can add them to it for no additional cost. A lot of times, if for a different entity, you'd have to get a separate umbrella for each one. That might cost $2,000, $3,000 a year. That can get out of hand pretty quickly. But with this new carrier we have, so one of my favorite features about them is we can just add all these different trusts and LLCs, no problem, no extra cost. Been doing that a lot.
What about the umbrella? Like I have 2 younger drivers, and so I'm not able to get a $300,000-$500,000 auto policy, which most trusts require because their age. My policies would cost me $15,000 a year if I did that.
Yes.
So
yeah.
Situation when you have teen drivers or younger drivers on your policy and you can't get your auto limits up to be able to qualify for them.
If we can't get the auto limits up to qualify for the umbrella, what we can do is we can still have an umbrella, and it can provide umbrella coverage for your rental properties, for your home, for everything else. It just won't cover above the auto side. So that's the limitation there.
Okay.
Some carriers are a little more lenient though in terms of how much coverage you need to qualify for an umbrella. So if that's a concern, we can shop that around and hopefully find a good solution, even if you do have younger drivers.
How much do an average umbrella policy cost a year?
Depends on how many properties you have, how many drivers there are, how old the drivers are. They look at all those kind of factors. But as a general rule, if you just want to, typically they come in $1 million increments from $1 to $5 million. And then for the average person, if you just wanted a $1 million policy and maybe you're married and have 1 or 2 rental properties, something like that, maybe $400 a year, $500 a year. They're very inexpensive considering what they do. And again, it's just that extra layer of peace of mind that I love them. I max mine out. I go 5 million all the way, always have. And the next thing is, depending on the lender's requirements, you may also need flood insurance, maybe earthquake insurance, maybe wind insurance, depending on the area. You know, if you're down on the Gulf Coast, a lot of policies don't necessarily cover wind, so you might actually get a separate wind policy. You might need, sometimes in California, you might need a separate fire policy. Flood, earthquake, just depending on the area. If they're not required by your lender, then they're just optional. You can still get them depending on your area and your risk tolerance and your concerns. Those might be things to look at, and we can do that for you as well. And then the last tip I have here is just don't be too cheap, because a lot of times you do get what you pay for, and you just really want to make sure the policy covers everything, you know, that you think it does and hope it does on the front end. And I'm the same way. The lowest price always looks good, but you don't want to get caught in the event of a claim if it turns out there's not enough coverage, and then you regret it. I've seen just recently there was a $100,000 water claim, and they only had $20,000 in water coverage. And on the front end, they were all gung-ho about it because they were going to save $200 a year. And now they have this huge bill, and they wouldn't have had that if they just paid an extra $200. So that's such a big thing. And I know we always want to get the cost down, but it's so important to think through all these different things, and especially on water claims, because water claims are about 70% of claims these days. And then other cost saving tips, because again, we want to save as much as we can. The more you buy in areas with more mild weather, the lower the cost of the policy is likely to be. Fewer claims is in the area, then there tend to be lower premiums. Whereas if it's an area that's, say it's like always getting hit with hurricanes, like if it gets hit with 10 hurricanes a year, that kind of thing, it's probably going to cost more because there's more claims, they usually have to pay more. So the more mild the weather, the better. Newer homes tend to have lower premiums as well because they figure, hey, newer home, it's less likely to have issues, less likely to break down, everything's up to code, it's not, you know, it's not worn out, there aren't potential maintenance issues. Newer roof, for the same reason, newer roof often gets lower premiums. Most carriers don't like a roof any older than 20 years. Lately, they've been tightening that up a little bit. Some carriers are saying 15. I've even heard some carriers saying no more than 8 years, but usually that's on the Gulf Coast areas. Some are a little more picky there. Another thing is you can look for bundle discounts.
I just put a metal roof on my new house that I bought. I bought a new house in Sarasota, Florida last year, in January 2024, actually this year. And that's the first thing I did. It had an older roof on it. And the first thing I did was I put a metal roof on it because you get such a great deduction for that with hurricane tie downs on it.
You can get a huge deduction. And not only that, but you get so many more carriers become options. If they see that the roof is old, you know, there might be, say there's 20 carriers that are willing to insure the area, but if you have an older roof, you might be down to 1 or 2 options, and they're probably going to charge a lot more. So having a newer roof you get way more options, and then you can shop around and find a way better deal, and you usually get a discount for that too, just like you said, absolutely. Other things you can do is looking for bundle discounts, and this is true if you have the same carrier, but even if the properties are in different states. So, you know, I'm originally from Newport Beach in California, where the main Marshall Reddick office is there. Now I'm in the Woodlands, Texas, moved here a couple of years ago, but just as an example, you could have a house here in the Woodlands and you could have another house in Clarksville, Tennessee, but if they're with the same carrier, you can still get a bundle discount and save money on both policies. Another thing is, again, if you have a professional property manager, a lot of carriers will offer a great discount for that too. Whereas they won't necessarily do it if you just have, you know, your buddy managing the property or someone who's not, you know, professional. And that's it for me.
I didn't know you can get a discount.
Oh, go ahead.
I didn't know you can get a discount for having professional property management.
Yeah, most carriers offer that. And
wow, go call all my policies.
Absolutely, call and ask, because just because you have the manager doesn't mean they applied the discount. And you can usually save, you know, maybe 5% or so, sometimes more. It just depends on the carrier, but save everything you can, right? Absolutely, because again, every dollar you save is just more cash flow on the back end.
Mm-hmm.
And that's it for me. So if you want a quote or even just a second opinion, feel free to reach out. That's my direct line right there. That's my email address. Give me a quick call. On average, it only takes 3 minutes, so we'll get it done real quick. Like I said, as much as possible, I want to make it hassle-free for you. Just ask you a couple questions, get a little more info. We'll shop all our carriers, find the best thing. I'll review the options, send it back to you, and then we can go from there. But reach out. I'd love to help, and hopefully I'll talk to you soon.
Great. So I don't know if any of you have done this before, but we have our free property rating ebook. If you haven't done this before or looked at this book before, I highly recommend it. It's approximately 38 pages, and you can get it on www.marshallreddick.com/ebook. It has great information on why we pick the areas we do, what are the demographics we're looking for, why is employment in the area important, how do we rate properties. We rate them from Lux, A, B, C, D, and F, and we truly believe on purchasing Lux, A, and B properties, but more tending towards the A and B properties. You're going to get the most appreciation and the most increase in rent in those. And then just repeating the model over and over again and copying a successful model. So if you haven't done so already, please go on and get this free ebook, or you can email myself or Steve, and we'd be glad to email you a link to it as well. It's marshallreddick.com/ebook. We have so many educational videos, articles, and guides on our website. If you just go to marshallreddick.com/learn, you can look at any of the past events that we have done. We have amazing events, like we have new home deals with builders right now, where we're getting forward commitment buy downs of rates in the 3% and low 4% rates on purchasing properties. So we have so many things on here. You can just look and peruse around the marshallreddick.com/learn page. So what can you expect from consultation with a Marshall Reddick advisor? I am a Marshall Reddick advisor as well as the Los Angeles Realtor, and then obviously I do these presentations. I love helping people. When we first initially talk, we talk about your goals, like why are you doing this? Why are you wanting to invest in real estate? And what are some of your short-term and long-term goals in investing in real estate? How? We evaluate all the options. What options do you have of coming up with down payment, or wanting to buy a property? Where do you want to buy the property? But how? We basically evaluate your options. Then when? Deciding on a time frame. Are you looking to buy right now? Are you looking to save a little money and buy in 6 months? Are you wanting to convert your retirement account and purchase properties through there? And we talk about that time frame. And then what? Setting your criteria. what type of properties are you wanting to buy? Are you wanting to buy a multifamily? Are you wanting to buy a single home, a condo, a second home? Where we identify the markets, what are the best markets for you to purchase in, and what has the best chance of appreciation and growth of your rental income, and then who. And then we introduce you to all the key players. We get you pre-approved. We get you set up with one of our area agents, whether it's myself here in LA, or myself as your advisor, and then maybe you're wanting to buy in Texas, and we connect with one of our Texas teammates so that we can get you set up into purchasing in the area that you want. So if you'd like to schedule a complimentary consultation, I would be more than happy to speak with you. You can reach me here on my personal cell phone, 818-694-0740, or on my email address. And I would love to get started and help you. So thank you so much for coming to our presentation tonight. We really are grateful for you joining us tonight, and we will be contacting you to see if you have any further questions. Is there anything else for you, Steve?
That's it for me. Thank you, everybody, for being here.
Yes, thank you so much.